Ladies and gentlemen, good day and welcome to the PNB Housing Finance Limited Q2 and H1 FY2024-25 conference call of PNB Housing Finance Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Deepika from PNB Housing Finance Limited. Thank you, and over to you, ma'am.
Thank you. Good evening and welcome, everyone. We are here to discuss PNB Housing Finance Q2 and H1 FY2024-25 results. You must have seen our business and financial numbers in the presentation and the press release shared with the Indian Stock Exchanges and is also available on our website. We would like to apologize because we could upload the presentation and the press release just few minutes back due to some technical error. We will try to cover maximum in the update to be given by the management team. We have the entire management sitting over here, led by Mr. Girish Kousgi, our Managing Director and CEO. We'll begin this call with the performance update by the team. Please note, this call may contain forward-looking statements which exemplify our judgment and future expectations concerning the development of our business. These forward-looking statements involve risks and uncertainties that may cause actual development and results to differ materially from our expectations. PNB Housing Finance undertakes no obligation to publicly revise any forward-looking statement to reflect future events or circumstances. A detailed disclaimer is on slide 51 of the investor presentation. With that, I will now hand over the call to Mr. Girish Kousgi. Over to you, sir.
Good evening to all the investors. Welcome to the earnings call. Before I get into Quarter 2 and H1 FY25 performance, I would like to highlight that the affordable segment Roshni loan book has crossed 3,000 crore mark this month, making us the fastest growing HFC in affordable segment. It is a significant milestone towards the stated target of 15,000 crore affordable loan book by FY27. On the loan book, last year, the retail loan book grew by 14.1%. Quarter 1 FY25, the book grew by 14.4%. And this quarter, the retail loan book grew by 16.2% to 67,970 crore as on 30th September 2024. This is against the stated guidance of 17% for the financial year. The corporate book is at 1,531 crore as on 30th September 2024. The total loan book stood at 69,501 crore and asset under management is at 74,724 crore. The total live accounts serviced by the company crossed 3 lakhs. The affordable and emerging market segment share in the retail loan book is witnessing increasing trend and is at 23% as on 30th September. The affordable segment has shown a remarkable growth of 300% on a YOY in loan book at 2,959 crore. We have crossed 3,000 crore loan book as of now. The emerging market segment has shown a loan book growth of 22% YOY at 12,545 crore. As per the strategy, the growth in the prime book is a balancing number and the prime book grew by 11% as on 30th September 2024. In terms of reach, we currently have a strong network of 303 branches across 20 states and we plan to open 50 branches in this financial year, with majority to be opened for affordable business. With this large presence, we are ready to capitalize the opportunity available in affordable and emerging market segments in Tier 2 and 3 cities. We had a phenomenal quarter with disbursement of 5,341 crore in Quarter 2 FY25, representing a growth of 28.2% on a YOY basis and 21.5% on a quarter-on-quarter basis. As laid out in our strategy, we continue to focus on affordable and emerging market segments. Both these segments contribute 31% of the total retail disbursement of Quarter 2 FY25. The disbursement in affordable segment grew at a rapid pace of 68.5% YOY to 630 crore in Quarter 2 FY25. The disbursement for the emerging market segment registered healthy growth of 31% YOY at 1,035 crores. The prime segment business grew by 23% YOY at 3,676 crores in Q2 FY25. The company is expected to start corporate business in next few months. The corporate segment will further help us in yield and retail business. The incremental yield in the affordable segment increased to almost 12% in Q2 FY25 as compared to 11.4% in Q2 of the previous year. We are consciously increasing the yield in affordable segment. The incremental yield in the emerging market segment is 9.8% in Q2, which is 45 bps more than prime segment. On PNB interest subsidy scheme, with the government focus on the affordable segment, that is EWS and mid-income group, and the PNB interest subsidy scheme, close to 1 crore customers are expected to benefit over next 5 years. This leads to a huge opportunity for players like us with pan-India presence and special focus on affordable and emerging market segments. The company is geared up to source business from all its 303 branches under interest subsidy scheme. On asset quality, GNPA improved by 11 bps to 1.24% this quarter. Last quarter, the GNPA was 1.35%. During the quarter, we recovered 48 crores from retail written off pool in comparison to 28 crores in Q1. We expect to continue recoveries from written off pool from both retail and corporate books. The company has a written off pool of around 1,250 crores in corporate and 500 crores in retail. Our cost of borrowing has reduced by 8 bps sequentially to 7.84% in Q2. In Q2, PAT stood at 470 crores, registering a growth of 22.6% on a YOY basis. Net interest margin increased marginally at 3.68% during the quarter as compared to previous quarter. We reiterate our guidance is 3.5% on NIM. We will be able to manage NIM at the current level for next couple of quarters. Our efforts across parameters aided in improving the profitability. Our return on assets improved to 2.54% in Q2 and H1 at 2.45%. Return on equity was at 1.42% annualized for Q2. Now I hand over to Vinay to cover on financials.
Hello, good evening to all, and welcome to Q2 and H1 FY2024-25 earnings call. I am happy to report a strong financial performance across all parameters during this quarter. Driven by strong business performance with disbursement growth of 28% and loan book growth of 14% and retail loan book growth of 16.2%, our overall PAT has grown 23% year-on-year and 9% quarter-on-quarter to 470 crores in Q2 FY25. Overall interest income has grown 4.5% year-on-year in Q2. However, this is colored by declining corporate book over the years. Kindly refer page 35 of the deck, wherein we have shared separate P&L by segment for retail and corporate. The retail segment gross income has actually grown by 17% year-on-year, and operating profit, that is pre-provision operating profit, grew by 16.4% year-on-year in Q2. Cost of borrowings reduced by 8 bps sequentially to 7.84% in Q2. The decline in cost of borrowings is driven by the benefits of rating upgrades, leading to competitive borrowing from debt capital market. Company also received ECB sanction of $125 million, which is at a very competitive rate. This has ensured that the spreads have improved from 2.1 to 2.2 during Q2. NIMs have also improved to 3.68% during Q2 versus 3.65% in the previous quarter, largely driven by the lower cost of borrowing. However, we reiterate we maintain our guidance of 3.5% NIM for the current year. With higher contribution of business now coming from affordable and emerging verticals, NIM should start improving from the next year onwards. Gross margin is maintained at 4.1 versus around 4.03 in previous quarter. In Q2 FY25, operating expenses have grown by 19% year-on-year to 199 crores. This is largely due to branch expansion done in Roshni and emerging vertical during Q4 of the last financial year, wherein we have added 100 branches. Excluding fresh investments done in these 100 branches, operating expenses would have grown by around 9%. This fresh investment will definitely help in profitable growth going forward. On credit cost, as mentioned earlier, it remains benign even during Q2 due to recovery of INR 48 crores from the retail written-off pool in this quarter. Overall credit cost remains a release of 24 bps for Q2 FY25. Our ROA improved by 30 bps year-on-year to 2.54%, which was 2.38% in the previous quarter. ROE has also reached to 12% for Q2 FY25. Company has maintained average daily LCR of 193% against the regulatory requirement of 55%. We have also maintained SLR of 15% on public deposits as of 30th September against the regulatory requirement of 13%. The capital adequacy stands strong at 29.16% with Tier 1 at 28.1%. With this strong all-round performance during Q2, we are on track now to deliver on our business growth guidance for the current financial year.
Thank you, Vinay. I will now request Dilip, our Chief Sales Officer for Prime and Emerging Business and Deposits, to give segmental performance updates.
Thank you, Deepika, and good evening, friends. Welcome to the call. Appreciate your taking the time out late in the evening. I'm delighted to share with you that we had a really good quarter in the Prime and Emerging Markets businesses for the company. You've heard some of the numbers from Vinay and Mr. Korsgi. You'll see them in the investor presentation as well. Over the next few minutes, let me try and give you some color of these businesses as to what they are and how they have fared in this quarter for us. I'll start with emerging markets first. See, we took this decision to reorganize our branches and teams into prime and emerging markets because we believe that these set of geographies or branches have room to, number one, grow at faster pace, number two, also give us higher yields on incremental disbursements. So we carved out 50 branches. We started off this business as a separate one about 2 quarters back. Firstly, let me speak of which of these markets. About 60% of these branches are in South as on date. So we are talking of most of Tamil Nadu except Chennai, branches in AP but not Telangana or Hyderabad, all of Kerala. Even in the north, we consciously chose the Tier 2 markets, so that some parts of UP but not Lucknow. Large share of Rajasthan but not Jaipur. So in these markets, our ticket size is around 25 lakhs, whereas our ticket size on the prime side of the business is about 35 lakhs. So at the end of 2 quarters, we are very pleased to see how the business has started off here. Disbursal in these markets, like you heard, has grown at 31% YOY. The book has grown at 22%. It's crossed 12,500 crores. We had set out a guidance saying over the period of 2 to 3 years, we will have a difference in yield of 75 to 100 basis points between the prime and the emerging market side. In 2 quarters, we have already achieved 45 bips. So the difference in incremental yields between prime and emerging markets is now 45 bips. In fact, in these emerging markets, we took the yields up by 40 bips in 6 months as compared to what it was at the end of Q4. In terms of product mix, NHL gives us about 35% of incremental disbursements in these markets. Again, this is a yield accretive business. It fetches us a good 100 plus bips of premium over home loans. In these markets, 63 to 64% of our business is sourced by our internal team, which is our in-house origination team. About 37% is originated by our third-party distribution DMS. And when we're doing all this and we're wanting to grow this business more, the asset quality in these set of branches, the NPA levels, is on par with those in the prime branches, if not better. So we're very pleased to have made this decision. It seems to be paying off well. It's taken off very well. We only see this business becoming bigger for the company, along with Roshni in the quarters to come. Mr. Kauski mentioned that EM, emerging markets and Roshni are now at about 31% of the company's retail loan disbursements as of Q2. Now this number or this metric by design will only go up in the quarters to come. Now coming to the prime markets. So most larger cities of the country, the metropolitan cities like MMR, NCR, Bangalore, Chennai, Hyderabad, Pune, even the bigger cities like Lucknow, Chandigarh, etc., they fall into what we classify as prime markets. Now since these markets have a higher share of contribution to the economy itself, they are larger markets for housing loan demand as well. So obviously we witness more competition in terms of pricing in these markets. That's why the yield on incremental disbursements in these markets will be a little lower. But owing to the sheer size of these markets, they will continue to contribute more to the growth for most lenders, as is the case with us. So on the prime side also, on the prime market side, we had a very good quarter on disbursal, on runoffs as well as margin improvement. We managed to grow our disbursements by 22+% in these markets. The book grew by about 11% to 52,000 plus crores. And on this side of the business, while we're working on growth, we're also working hard on restricting our runoffs. So our runoffs here came down to below 17% on an annualized basis. Now this is a good 2+% reduction YOY. This improved 40 plus bps QOQ sequentially as well. And while we are wanting to grow in these markets for bottom line reasons, we are also making the shift down the income pyramid from HNIs or super prime to the prime or the mass affluent segments. So the incremental disbursements are more granular in nature. Just to give you a metric, 97% of the disbursements in these markets stood at loans below 3 crores, which is much lower than what the company is used to historically. In these markets also, we managed to take the yields up. Incremental disbursements yield moved up by 15 basis points in 6 months. I'd also like to share an update on investments in new branches. We opened about 35 new branches in Q4 of FY24. Happy to share that all these branches are now fully operational. They are active on incremental disbursements for us. They contributed to 10% of the disbursements across prime and emerging markets for Q2 for us. This number was 6% in the previous quarter. So this should only go up in the coming quarters. So to summarize, growth in business is auguring well on the back of investments in geography and technology. We wanted to grow more in the margin accretive businesses, be it emerging markets, be it NHL. We are seeing that happen. The shift in the customer segment in prime markets is happening as planned. The shift in the geography mix is also trending in the direction we want. Just to give you an update, across prime and emerging markets, 50+% of the incremental disbursements are now coming from non-metros. This is the first time across these businesses. And the asset quality for these businesses continues to hold up and improve quarter on quarter. So we believe that a good performance in Q2 is a testimony to the fact that we are on the right path and we'll only move forward on these businesses on all our imperatives, growth, margins and asset quality. Thank you and back to Deepika.
Thank you, Dilip. I will now request Anushai, our business head for affordable business, to update on the affordable business performance.
Thank you, Deepika. Good evening, everyone. It is my pleasure to take you through the excellent outcomes that we have achieved in the last quarter in our Roshni business. We have ended the last quarter at a loan book of rupees 2,959 crore, and I am happy to share that we have become the fastest business in the affordable housing space to cross the loan book of 3,000 crore earlier this month. We have achieved this milestone in the 22nd month of our operation. Our journey in the affordable housing finance space started in January 23 with Roshni business disbursing rupees 5 crore of loans in that month. Executing well on our strategic plan, we reached a monthly disbursement rate of around rupees 100 crore per month in about 6 months' time by July 23. We were the fastest in the affordable housing finance space to reach a loan book of rupees 1,000 crore in just 11 months' time by November 23. We opened our 100th branch in December 23. Incidentally, this branch was also our first women-only branch that was set up in Chennai. With increased branch footprint, our loan book growth was even faster from there on, and we ended the FY24 at a loan book of rupees 1,790 crore in March 24. As I mentioned, we crossed 1,000 crore of loan book in November 23. The next 1,000 crore came even faster, and we crossed loan book of rupees 2,000 crore in next 6 months by May 24. We also opened 60 more branches in Q4 of the last financial year. I'm happy to share that all these new branches have been fully operationalized in the last few months. With these 160 branches across the country, we are catering to 130 plus high potential targeted districts across 13 states in the country. We are operating in the 3 zones, and contribution is evenly distributed amongst all these 3 zones. North zone accounts for 34% of our business. Contribution from West zone is about 36%, and South accounts for 30% of our business. We have a national presence, and this helps us in scaling up faster across all regions in the country. In the last few quarters, we have worked hard to expand and strengthen our distribution. We have empaneled close to 2,000 connectors through our Roshni Sarthi program. We have also empaneled close to 500 channel partners for DSA partnership. We have also strengthened our vendor support network for legal, technical, FI and FQ related checks with more than 1,000 empaneled vendors across the country. We have also used technology solutions extensively to strengthen our operational framework. The last quarter has been our best ever quarter in terms of logins and sanctions, and we have been able to build a robust pipeline which will support the business growth going forward. Roshni loan book has witnessed a 3x year-on-year growth as we have ended the last quarter at a loan book size of 2,959 crore as compared to rupees 745 crore that we had at the end of quarter 2 of last financial year. Quarter-on-quarter growth in the loan book stands at 25% plus. Roshni disbursements have also seen a robust growth, year-on-year growth of 68.4% as we disbursed 630 crore of loans in the last quarter as compared to 374 crore of loans same time last year. While we have grown our disbursement significantly, it is important to note that we have also improved our incremental yields simultaneously. Yields for incremental business have gone up to close to 12% this quarter as compared to 11.4% same time last year and 11.58% in the previous quarter. We have been able to improve our yields through an increased focus on higher yielding segments and products. Self-employed sourcing has gone up to 43% in the last quarter as compared to 35% last year. Sourcing from informal income segment has gone up to 29% in the last quarter as compared to 23% previous quarter. Our non-home loan sourcing has also gone up to 35% in the last quarter as compared to 25% same time last year. With most of the new branches getting opened in Tier 3 and Tier 4 locations, this will become an additional factor, and we are confident our yields will continue to improve. On the portfolio quality side, we don't see any early warning signs. As I mentioned earlier, we have been able to execute really well on the strategic plan that we have for Roshni business, and we are confident that we will be closing this financial year with a loan book of close to rupees 5,000 crore. Thank you.
Thank you, Anuj. I'll now request Zakul, our Chief Credit and Collections Officer for retail, to talk about credit and collections performance.
Good evening, everyone. Moving on to cover the portfolio quality and credit, well, I can say that our PNB Housing is risk first in business next. Credit underwriting plays a crucial role in driving business and building a strong portfolio, ensuring sustainable portfolio quality. This function here operates independently, assessing both the financial capability and collateral through dedicated legal and technical units. The company today manages a robust and seasoned portfolio of around INR 68,000 crore, consistently achieving steady year-on-year growth. With a deep understanding of the various facets of the mortgage industry and the relevant experience of our team, we make informed onboarding decisions. This expertise allows us to build a diversified portfolio, maintaining a balanced distribution across various industry segments, low and mid-ticket size cases being focused, and a healthy mix of salaried and self-employed customer segments. As the business grows organically, our well-established centralized monitoring mechanism conducts periodic testing of the portfolio on us and off us, providing an eagle-eye view of our business health. So as we speak, our portfolio shows no sign of stress. Covering the credit process flow evolving around login, credit appraisal, collateral assessment, and finally the disbursement, each of these stages ensures that the lending process is thorough, minimizing the risk and maximizing the profitability of repayment. Right from the loan application submission, which is done through our digital platform, till disbursement, at each stage of the appraisal, one or the another digital tool deployed by the company is, be it the verification of documents to automated CAMs and bank statement verifications, etc. So this ensures faster and timely delivery to the customer. Now moving to the portfolio highlights for quarter 2 of the current year, the company witnessed business growth as already mentioned. As envisaged with respect to focus areas of control, 94% of the fresh sanction volume has ticket size of up to 1 crore. 87% of our incremental business had bureau score of more than 700. Having all the checks and balances in place with respect to prudent appraisal and managing early mortality, the delinquency in the business booked in last few quarters is well within the tolerable limits. To give you an idea, as on 30th September, 30 plus from last 12 months origination is 0.1, and with the mere NPA that is 90 plus is 0.02. If I go back and see last 24 months also, 30 plus is 0.43 and NPA is at 0.09%. So that gives us the confidence to enable business growth with sustainable portfolio quality. Now moving further to collections and recoveries. The company has been witnessing a successful trend over the past few quarters with complete grip on delinquent accounts, various approaches of curing methods put to use, ensuring sequential reduction in NPA quarter on quarter. The strategy which we designed in the recent past and implemented at ground is yielding desired results as per our plan. Resolutions across buckets have been improving, driven by strategic interventions, both from a process excellence and technology leverage point of view. The focus continues to remain on early delinquency management through leveraging deeper analytics and focus to increase self-curing of early delinquency, deployment of predictive AI models to improve accuracy on pre-delinquency management, and ongoing monitoring and prompt resolution of any early mortality cases arising from the recent acquisitions. And the next focus area, which is to arrest the vintage delinquency, is control over the NPAs and recovery from the written-off pool. This is being enabled with the use of effective legal tools or measures to restrain delinquency, leverage of end-to-end technology through a collection application which is being used to track the collection field performance, digital capturing of payments, and enables us to review through dashboards and various analytics. Optimizing the process for one-time settlements and reserve price fixations, etc., strengthened our auctioning process. I will just cover the numbers in a minute to go. And month-on-month consistency of sale of repossessed assets by taking one-of-its-kind industry-wide initiatives which has really helped us to get to the desired results. Over the quarterly update, the company closed the second quarter building on the momentum we established in Q1. Performance was robust in Q2, whereby we beat our Q1 numbers on almost all the measurable success metrics. Our ongoing rigor on SAFETI saw us take over 300 positions in quarter two, which is far more than what we did in quarter one, close to 170 odd positions. Further, to dispose of these assets, we successfully sold off 134 properties in Q2, as against 98 in Q1, through the auctioning channel. So this vertical, this has been a very success in disposing of the assets as well as the reduction in NPAs by taking one of its kind initiatives, as I talked about, be it marketing, be it creating awareness to dispose of these assets. In terms of recovery from the technically written off pool, we collected almost around 50 crores in quarter two as against 28 crores in quarter one. So the strong control over recovery and resolution mechanism has set the growth trajectory in terms of robust portfolio with even lower delinquency. Given the proficiency in handling all aspects of collections, recoveries, to sale of assets and overall resolution mechanism over the last few quarters, the company has set a path for reducing NPAs further and build a robust portfolio with steady growth. Thank you.
Thank you, Jatul. I'll now request Anubhav, our Chief Technology Officer, to talk about our tech initiatives and its progress.
Thank you, Deepika, and a very good evening to all. PNB Housing Finance Technology Function continues to evolve on the path of transformation agenda that was initiated in quarter 4 of FY24. I'm pleased to share that as part of our transformation journey, we have upgraded and replaced our key core platforms like CRM, Dialer, LOS, website, and deposit. We have also introduced additional tech-led channels for sales, collections, operations, and customer service functions. All the new platforms are high-performing in terms of functionality, features, capacity, and performance. The new and upgraded platforms are set to deliver long-term robust tech capabilities for our business segments and customers. Our long-term technology vision is to be recognized as a large tech-led digital player in the HFC ecosystem, partnering with various fintech, banks, and aggregators through scalable digital platforms and tech services which are integrated end-to-end. All our technology investments are aligned to the business strategy and direction and focus on 5 strategic pillars. The first is delivering a frictionless customer experience. This aims to simplify and enhance experience for our customers across all channels and touchpoints. We have launched a new website that provides far more information, and the same is disseminated to our customers and prospects. We have introduced self-service channels like chatbots and WhatsApp bots, where almost 17 to 18% of customer requests are being self-serviced 24/7. Our second strategic pillar is end-to-end sales enablement. Initiatives like introducing a sales mobile app for our frontline, automated lead scoring and allocation have been implemented. We have also introduced a fully functional app for our collection agents to be better equipped with all data and details in a secure manner to improve collection efficiency. The third pillar is creating underwriting at scale. This focuses on our credit function, where we have built several calculators. Automation for underwriting includes digitization of complete underwriting rules using a robust rule engine, and the same have been implemented and used widely. Our fourth pillar and focus area is to evolve into a data-driven enterprise. We continue to invest in building data analytics capabilities across organizations. We are in the process of setting up a vast data lake to build an integrated analytics view, pan enterprise and business segments, which will be used for developing numerous analytical models for prediction of risk, delinquency, conversion propensity, and for enabling MIS and reporting across hierarchy for better management and control of the business. And our last pillar of focus is tech innovation and performance. While delivering superior business capability, we are also focusing on building internal tech skills and capabilities, specifically in areas around cloud, mobility, engineering, performance engineering, tech monitoring, and information security, which are very relevant in the technology landscape of today. In recent quarters, we have automated considerable part of our customer service touchpoints and introduced digital channels for customers to connect with us. As on date, these self-service channels are working well for us and have led to improvement in CSAT as well as unlocked better productivity for our operations teams. Sales enablement initiatives include introducing modern and integrated LOS platform that has better control workflows and improved form filling capabilities through automation and integrations. During the onboarding journey, we are now more than 80% digitized for the affordable segment, and we are launching the pilot phase for prime and emerging business segments. Entire field collection team is enabled with a robust mobile app that provides all details of delinquent cases, field tracking, complete payment automation workflow, and associated capabilities for collection agents to leverage. Lastly, we have set up 24/7 information security monitoring capabilities and continue to build resilience on our technology platforms in line with the new and emerging cyber threat landscape. Information access for users is also controlled using relevant tools which work purely on a zero trust architecture model. Thank you.
Thank you, Anubhav. Sagar, we can open the forum for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Good evening, everyone. Thank you for taking my question. First of all, congratulations on a good quarter, and again, congratulations to Girish sir for recently completing, I think, 2 years at PNB Housing. So first of all, thank you for, I think, very enhanced disclosures that we are giving in the presentation. I think we also started giving out incremental yields. So I think that's where my first question also was, that in terms of incremental yields that we've given out in prime, emerging and affordable, what proportion of this increase in incremental yields that we've seen over the last 2 quarters, what proportion has come from a product mix change, and what percentage has come from an increase in yields that you have been able to take in home loans?
Thank you so much. Thanks, for the compliment. So, the plan this year was to increase the yields on all the 3 segments, starting from affordable, emerging, and prime. So we started focusing on increasing yields, let's say from June of this year, because Q1 given the constraints and cyclical, and therefore we started this couple of months late, and we have seen good traction. So if you look at any of these segments, whether it is affordable, emerging or prime, yield is driven largely by, customer segment, geography, product and the program mix. So these 4 things have driven, towards increase in all the 3 businesses, prime, emerging and affordable.
Okay. And so, just a related question on yields again. Emerging, affordable, we can understand, but the fact that you're also able to take yield improvements in prime is in itself commendable given the kind of competitive landscape that we have in the country. So what is allowing us to improve yields even in prime?
So, as I mentioned, even on the prime side, we are, and we will be, always exploring opportunities, sub-segments within prime, so that we can try and increase yield. It's also a combination of the program and the product mix and customer segmentation within the prime.
Yeah, to add to what Mr. Kausgi said, the 2 bigger levers in prime side of the business which have helped improve yields is, one is shift down the pyramid. So we have vacated the sort of ultra HNI kind of customer segment. We see possibility to charge better premiums when you go down the income segment. That is number 1. Second is a little bit of product mix as well. We are doing a little more NHL than what we used to earlier. We are also trying to see if we can move up that ladder. Combination of these and some of the factors which Mr. Kausgi explained is helping us increase our yields.
Good. Thank you. My second question was on margins. When Vinay sir was giving out his opening remarks, I think I heard that, while margins have been good for the first half of the year, are we still guiding for a margin of 3.5%? So, should we then conclude that maybe for next 2 quarters we could see some NIM volatility, and then as per your guidance, NIM should start improving from the next year onwards?
So NIM will start improving maybe after 2-3 quarters time, as I've been mentioning since a very, very long time. We are putting in all the efforts to protect the NIM. We have given guidance of 3.5%, that is a threshold. So NIM will be upwards of 3.5%, while the endeavor will be to try and maintain at around 3.65%.
Got it, sir. That's good. Sir, the last question again is I think we've guided that for the next 4 to 6 quarters, we'll continue to see recoveries from the return of pool. I think this was the second quarter where we took a provision write-backs in the P&L. So 2 things I want to understand in terms of recoveries. One is, when we go for repossessions and auctions in retail, what is the recovery that we see? In other words, what is the haircut that we are seeing in retail when we go for recoveries? And secondly, given that you spoke about almost 1,250 crores of return of pool in corporate, and corporate recoveries we know can be lumpy. Anything happening on the corporate recoveries, and are you expecting any corporate recoveries in the second half of this fiscal year?
Yeah, so as of now, we have 1,250 crores written off pool on the corporate side and 500 crores on the retail side. And if you look at quarter 1, quarter 2, I think together we've done about 28 plus 48 crores in quarter 1 and quarter 2, a little over 75 odd crores. So this story will continue for next 4 to 5 quarters. On the corporate side, as I had mentioned in the last earnings call, we were able to recover a bit in quarter 1. So in H1, we can expect good recovery on the corporate side, also on the retail side.
Got it. So this is useful. Thank you so much, and I wish you and your team the very best.
Thank you. I think I didn't mention H1. I think in H2 we are expecting recovery from corporate also, and retail recovery will continue for next 5 to 8 quarters.
Okay. All right. Thank you so much.
Thank you. The next question is from the line of Renish from ICICI. Please go ahead.
Yeah, hi team. Congrats on a good set of numbers. So first question, again on the credit cost side. So, of course, we do understand that the revamp collection underwriting structure, is helping us in better recoveries, etc. But on a normalized basis, given now corporate is only 2%, so what kind of a steady state credit cost one should assume, in retail business, especially when, we are, let's say, over next couple of years, affordable and emerging will be larger piece in prime. In a way, these 2 segments will be slightly more vulnerable than prime. So what steady state credit cost one should assume for PNB Housing going ahead?
So on a steady state, for example, we have given a guidance, in terms of retail book growth, reaching the 1 lakh crore by FY27, with a mix of 15% in affordable, 25% in emerging, and the balance in prime. So on a steady state, given the mix between these 3 segments, we should look at credit cost of about 40 to 42 basis.
Sorry, 40 to 45 basis points.
Yes.
Okay.
40 to 42. 41, 42.
Got it.
So I think on prime, we are expecting on a steady state credit cost of about 18 basis, on emerging around 20 to 24 basis. On affordable, since we are focusing on the low risk and middle risk segment, we are expecting about 50 basis. So as a combination blended within retail, we are expecting credit cost about 41, 42 basis.
Okay. Maybe I think if we go by this mix and the kind of credit cost you highlighted, I think the blended should be lower, but anyways, I think we'll discuss separately. The second question, again, on the yield side, in the prime segment, as Abhijit was mentioning, this is one of the most competitive product per se. And in that segment, from last 2-3 quarters, we are seeing this steady improvement on the disbursement yield as well as the book yield as well. I do heard that, we are vacating ultra HNI and sort of going down the pyramid. But structurally, what are we doing to sustain this kind of a yields, on a more sustainable basis?
Yeah, Dilip sir, like I said, we are trying to be on the fringes of the outskirts of the city. We are trying to cater to middle income customers. We are trying to do a little more of NHL as compared to earlier. Between these 2-3 levers, we are able to fetch higher yields than before. And this is a journey. We've just started off. We have walked about 15 bits in the last 6 months. We believe there is still room for improvement here. I remember mentioning this in our earlier conversations as well. Even if you take cities like Bombay, Delhi, NCR, the yields that the ultra HNIs give us in the middle of the city are very different from what you get when you go to the outskirts of the city. Even to catering to salaried middle income customers or self-employed customers gets us better yield. So between these 2-3 things and a little bit of product mix NHL, we believe that we will be able to take the yields up. And early results seem to be showing that we are in the right direction. We will be moving ahead on this path.
Got it. Does that mean there is a significant change in the ticket size?
Not really. It's come down a little. On the prime side of the business, we are in the range of 35 lakhs. We're trying to be more granular. We used 4-5 years back, historically, we used to do many more cases which are sort of 5 crore plus, and that has come down.
Yeah, that's what. Okay, got it. So earlier maybe we were in crores, now we are in lakhs.
Yeah, a little.
Okay, got it. And my last question on the cost of borrowing side. So despite the rating upgrade, incremental cost of fund has increased maybe though marginally by 700 basis point. But ideally, incremental cost of fund should have come down, right? Post rating upgrade. So what am I missing here?
It is basically, Ramesh, due to some mix, as the bank mix between short term and long term do keep changing quarter on quarter. That has led to some impact between Q1 and Q2. We have also got some ECBs and NCDs traction starting from Q2, which is also playing out from improving the diversity and mix perspective.
Got it. So basically just a mix change which is impacting this. There is nothing much to read.
And also if you see, we got the rating upgrade in Q4 of last year and Q1 of this year. So that will play out. And also if you look at the difference between us in terms of cost of borrowing and some of the leadership for companies in terms of cost in the space, I think the gap is not much. So we'll be able to cover that up. And also in next 3 to 4 quarters time, it's question of time. We are also looking at possible upgrade, and we should further improve on the cost.
However, having said that, overall borrowing cost from the portfolio has improved by 8 basis. So there we have worked across all the instruments.
Got it, sir. Oh, this is very helpful, sir. Thank you and best of luck, sir.
Thank you.
Thank you. Next question comes from Nilesh Jethani from Bank of India Mutual Funds. Please go ahead.
Yeah, hi sir. Thanks for the opportunity.
Sorry to interrupt, Mr. Jethani. Your line is breaking in between.
Am I audible now?
This is much better, sir. Please go ahead.
Okay, thank you. My first question was on the affordable side. Just wanted to understand, considering this 160 locations where our branches are present, any sense or any understanding the corporates which are operating around us, what could be typical AUM per branch for them, and of course, what kind of AUM per branch are we aspiring to when we target to reach this 15,000 crore AUM by FY27? That is question number 1. Question number 2 is on what are you planning to do on the affordable side? Trying to garner market share in tier 2, tier 3 cities, or we are targeting virgin market, a mix of virgin and market share gain? Just wanted to understand the philosophy.
See, in terms of growth, we had guided 17%, so this could, improve in next couple of years, since we are trying to scale up in all the three segments within retail. Now, looking at CAGR in terms of all the three businesses what we have spoken, so we are expecting to reach a book of about 1 lakh by FY27. So this, by FY27, today we are at 303 branches. So in next 3 years, starting from this year, we will be able to reach to the level of 500 branches. So the split is going to be all the branches what is going to open in future. I think 75 to 80% will be on the affordable side, and the rest will be on the emerging side. I think 500 branches, 1 lakh retail book by FY27. That's the plan. And we plan to grow at about, let's say this year we have guided 17%, next couple of years will be slightly higher. I think that's the plan. In terms of affordable, specifically, I would request Anand to.
Yeah. On the affordable side, I'll just try to set some context. When we were working on the distribution blueprint for this business, we realized that there are about 155 districts across the country out of 550 to 600 districts that we had at that point in time. So around 155 districts were found to be high potential districts for our kind of targeted business. And out of these 155 districts, so far through these 160 branches, we are catering to about 130 plus districts already. These districts are concentrated in about 14 to 15 states in the country. Out of these 14, 15 states, we are already in some form, we are present in about 13 states. Within these 13 states, and plus there are a couple of more states which we want to target, there is ample opportunity to open about 150 to 200 more branches.
Okay. And on the AUM per branch, we wanted to understand currently the locations where we are operating, our competition would be operating at what kind of AUM? Just wanted to understand, today our AUM per branch optically looks much lower considering the faster growth in branch addition what we have seen. So we wanted to understand, say, from tomorrow itself, hypothetically, we stop adding branches. So what could be AUM per branch potential for us in the current location itself?
So I think talking about affordable, if you see some of the mature branches for us, we have reached little over 2 crores per month. So we feel that on the affordable side, on an average, branch could reach a potential of about doing 3.5 crores disbursement every month. So that is, let's say after 12 to 15 months from the start. So depending on the vintage of the branch and the location potential, I think the branch could reach at let's say about 3.5 crores on average.
Got it. I'm sorry to again circle back on the question. So when so you mentioned that in the current location there is scope to add even 150 more branches. So this refers to these are underserved areas, or we can capture a higher market share in a decent sized market. What's the thought process?
See, it will be a combination of tier 2, tier 3, and tier 4. Right? It will be a combination of yield and volume. So it will be a mix of these two. For example, tier 2 or tier 3 would get us more volume, and part of tier 3 and tier 4 would give us a better yield. So it's a combination of these two. Which is why I mentioned, I think one branch in a month can reach to the max potential of, on an average, 3.5 crores. So for example, some of the affordable branches, let's say in cities like Bangalore, Chennai, Hyderabad, could do even 7-8 crores per month. And some of the branches in tier 4, they could do, let's say, 1 to 1.5 crores, but the yield will be much higher. So it's a combination of both yield and volume.
Okay, got it. And one question on the corporate side, we wanted to understand the plan to rebuild up or refocus on corporate from next quarter onwards or maybe next two. Just wanted to understand how different this is going to be versus the earlier avatar where PNB used to spend a lot of build a finance or something like that. So how different are we this time?
The two things will be starting corporate in next couple of months, and this time it will be very different. We will stick to basics, and we will focus on ticket size around 200 crores. We will not get into chunky deals, and this will be only into construction finance. And in terms of scale and size, corporate business at any given point in time will be less than 10% of the overall portfolio.
Okay, got it. It was really helpful, and thank you so much.
Thank you.
Thank you. The next question is from Harshit Toshniwal from Premji. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes, you are audible.
Okay. Sir, on this affordable piece itself, that you mentioned that the incremental yield which we are having is roughly around 12.5% right now. But now, if you look at this segment and the other peers, now, do you think that this is a good enough yield to charge for that customer segment that can cover our OPEX and possible sustainable cyclical credit cost? That is the one. And the second part, sir, also, how much of our new disbursements in this segment is through DSAs, specifically the affordable one? If you can help on that aspect. And when I say DSA, when you say that in-house, I mean employee sourcing mostly through DSAs. I would also want to look at that mix, the direct versus DSA part. And third, sir, if you can just give a breakup of the employees between the prime, emerging, and affordable as on today.
So in terms of within affordable, there are three segments. So low risk, medium risk, and high risk. So if you look at our yield in the first year, let's say in last year, the yield was about 11.4, 11.5. And this year we guided the yield of about 12.6%. And for next year, the yield is going to be more than 13%. Now, this would be largely driven by change in segment and change in profile, both in salaried and self-employed. Right? And we will be focusing on low risk and medium risk. So we will not really focus on high yield segment. And therefore, according to us, I think yield from affordable segment would be a little over 13% is what we would focus on. There could be opportunity at a lower yield, there could be opportunity at a higher yield, but I think our focus would be on low risk and medium risk, and in terms of next year it is going to be little over 13%.
So just to hear that, at this point of time when we look at our disbursement, are basically customers who would have otherwise gone to AFCs like Aptas, Avas. So although the larger set of AFCs, so is our customer segment there very overlapping? And the second part was related to this itself of the incremental disbursement. How much is BT in our case, where we are basically it's not a new loan, but it's more coming from somewhere else?
So in terms of the customer profile, I think to a large extent, if we talk about low risk and medium risk, I think the customer segment is same.
Okay.
Number one. Number two, in terms of BT for affordable, it's about 25-26%. Okay. And one more question you had asked in terms of what is the mix between direct and DSA. DSA is 31% in the affordable, and the rest is direct.
Got it. And sir, one last thing, I think on the employee part, you can give the breakup of employees between the three, specifically the sales or basically the branch employees.
See, I think for us, whether it is credit or sales, basically we have a branch structure. So in branch we have different categories: low potential, medium potential, and high potential. So low potential would have one sales manager, one credit manager, and one ops resource. So if it is a mid-size, then we would have one sales manager and probably one ASM and one underwriter. If it is a big branch, then we could have two underwriters and we could have two ASMs and one salesman. This is our structure. In terms of total headcount,
is Roshni out of total headcount on say sales side on an overall basis around 25% would be Roshni affordable. Rest is between prime and image.
Okay, 25% would be affordable. So I remember, sir, you last time mentioned that there were 333 employees in the affordable segment.
Now we have a little over 400 employees in Roshni.
Okay, got it. Got it. Thank you.
Thank you. Next question is from Viral Shah from IIFL Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity to ask. Let me ask the question, and congratulations on a good set of number. Girish, first question was on the point of with regards to the NIMs. I know that this was asked, but wanted to check, given where we are, does it make sense for us to say raise the guidance, or as you mentioned that this is the threshold, is it after taking into account say any impact of potential rate cut?
Yeah, that's right, Viral. The environment is slightly volatile. So we are baking in the impact of the rate cut that can come in. Our endeavor is to maintain 3.6% plus, but yes, as a guidance, we would like to maintain 3.5 for the year.
Got it, Vinay. And Vinay, as we go ahead, as the mix kind of changes a bit more in terms of borrowings, do you see this the cost of funds further inching up?
No, not really. Cost of fund for us should remain in the similar range. Actually, it should see a downward trajectory.
Got it. And the last question I had was with regards to the asset quality front. So you have given this data with regards to the 12-month and the 24-month MOB, how the delinquencies have trended on 30 and 90 plus. Can you help us with whatever this number say a couple of quarters back? And also, secondly, if you can help me with regard to the affordable segment of this piece.
See, early mortality always has been the focus of the company to monitor the early delinquencies of 12 months, which we have strengthened now to cover even up to 24 months. So if I look back a couple of quarters, I think these numbers are a shade better than the earlier times. And having said that, and even on the Roshni is a pretty new book around 3,000 odd crores. So there is hardly, I think, 10, 12 number of cases into NPAs, which our resolution is in process with sufficient cover available. So that's not a significant number as of now.
Got it, Jatin. Jatin, when you said that these overall numbers are a shade better than what they were, are you referring to say versus 2 or 3 years back, or are you referring to say 2 or 3 quarters back?
So around 6 to 8 quarters back, and this I am talking only on aspect of early mortality. And overall also, as you can see the graph quarter on NPAs particularly coming down each quarter. So that is on NPAs, but having said that, the pre-delinquency management has been strengthened because the business is on a growing spree now. So we need to have stronger controls to restrict flows. If our flows are restricted and we have a well-defined strong mechanism in terms of taking properties to SARFAESI and then auctioning it on a regular basis. Almost we are selling 2 properties a day now. So that machinery will take care.
Got it. That makes sense. And thank you so much and all the best.
Thank you.
Thank you. The next question is from Omkar Shinde, who's an individual investor. Please go ahead.
Yeah, thank you for taking my question. I have a few clarifications before I ask my question. So we said that we target 1 lakh crore AUM by FY27 and 15% of it will be affordable. Was that correct?
Yeah, that's right.
Okay. And 2 more clarifications. In one of the previous questions, you had said that credit cost in the affordable segment could be somewhere in the region of 50 bits, 50, or was that 15? I did not get that properly.
50.
50. Okay. And now coming to the question. So again, with respect to the branch structure, you had said the small branch will have one salesperson, one credit person for the small branch. So is this also applicable for our affordable branches? Because now, as you said, 12 to 15 months is the gestation period for a branch to reach 3.5 crore disbursement per month. So some of our earlier branches would have reached that. So would they still, so where in the small, medium, large would these earlier branches be now? And how, and could you just reconfirm the medium and large structure?
What I had mentioned was for affordable, and what would happen is that, let's say you open a branch, okay, and depending on the potential, you will increase the manpower, and then the branch could peak to the peak level of 3.5 crores. So this also has a combination of A, geography, B, in terms of potential. So on an average, let's say we have, let us say, 300, 400 branches with a vintage of, let's say, 15 to 18 months time. On an average, I think the peak could be about 3.5 crores. So the branch structure, what I mentioned, was for affordable. On the emerging and on the prime, so one branch could have multiple ASMs, multiple ROs for the field executives, sales executives, and one branch manager. When it's a branch manager, sales manager, and then we would have credit and ops.
Understood. So I was asking with respect to that only for the affordable itself. So when the branch reaches this peak level of 3.5, 4 crores, what is the structure? And like, is that at that point of time, it is like a large branch or a medium branch? That I wanted to understand.
So let us say we'll categorize A, B, C categories, right? A category branches would be doing, let's say, about 6 to 7 crores. B category branches could do about, let's say, between 4 to 4.5 crores. And C category branches at its peak would be at 1.5, 1.8 crores only. So it depends on the category of branches, which is linked to the potential and the geography. And therefore, I always talk about average.
Understood. Now, with respect to sanction to disbursement, now what I have seen is on a quarter-on-quarter basis, from the what is mentioned in slide number 20 to 21, our sanctions have sanction to disbursement ratio has dropped to 56% approximately from 75% in Q2 last year. Why is there such a big drop in the sanction to disbursement? And are we going to see some spillover effect in the coming quarters for this? I just wanted to understand this.
This you are referring to the affordable business?
Correct. Yes. Slide number 21. So 630 crores of disbursement against 1,100 crores of sanction. So 56%. So there is a big drop from last year where it was approximately 75%. So why is there a decline?
Yes, so there is a decline only because of some process-related changes that we have done in July. But if I look at so the quarterly numbers are lower as compared to the previous quarters. However, if I look at standalone numbers for August and September month, our conversions are back in order, and from next quarter onwards, you'll be able to see the similar conversions upwards of 70% as we move forward.
Understood. And finally, with respect to the incremental yield, we are at approximately 12% as per the slide mentioned.
Right.
Where does the incremental yield settle over the next 3 to 4 quarters? Because when the rate cut starts to come from RBI, we will also have some very little headroom. So what do you think that the incremental yield and the overall yield will peak out in the affordable segment?
So when it comes to incremental yield, we are confident we will move towards close to 13% of yield.
See, I think the context is today, if you look at, our cost of borrowing is around 7.8, 7.85. Right? With this cost of borrowing level, we are talking about affordable yield of 13% in next year. Suppose, let's say, the rate goes down, let's say by 100 basis. So then the 13% would slightly moderate to that extent, might slightly come down. So what we are saying is we will protect the margin. So for affordable business on a steady state, the yield is going to be 13+%, 13 to 13.2%, given the current cost of borrowing. So if there is any change in the cost of borrowing, accordingly even the yield would vary.
Okay, understood. And just finally, one last one. The overall OpEx to AUM is also increasing. That is, I think, as a function of us expanding the branches very fast. So where does that finally settle over, say, by FY27, when we reach the 1 lakh crore AUM? Can you guide where in the ballpark range would that OpEx to AUM be?
See, we are expecting it to settle at the current levels of 1.1 to 1.1%, where it is right now. As large part of the upfront investment is done, now it will be a minor investment of 40-50 branches every year, which we will manage through the economies of scale in other business.
Okay, thank you. That was helpful.
Thank you. The next question is from Nikhil Kumar Agarwal from VT Capital. Please go ahead.
Hi, thank you for taking my question. I just had one question. You said that NIM will start improving after a few quarters. And since cost of funds is going, like incremental cost of funds is going to be at the current level of 7.8%, and yields are improving across products, then NIM should ideally start improving right now, right? As in from next quarter itself. So it should go very well, as per whatever you have said about yields and cost of funds. So, can you please give more light on this?
So there are a couple of things. So one is, we will be starting corporate shortly. Once we start corporate business, then it will add to yield, number one, into margin. Number two, we also have book depletion on time, emerging, and to a very, very small extent on the affordable. So that is one, which will again impact revenue and base of the margin. Number three, we also have a repricing policy where we try to retain the customer, and switch from a higher interest rate to a slightly lower interest rate. Now, these things would pull the yield down, while on one side the yield would come down because of foreclosure, because of repricing. On the other side, we are changing segments. We are moving more towards affordable and energy. We are increasing, the mix change, which would come at a higher yield. So this would, ensure that the yield will go up. So because I think this balancing would play out in next 2 to 3 quarters, and forcing the yield to start going up.
Okay, so because of the dragging effect of the things that you mentioned, the current yields will be maintained for a few quarters, and then net yield should start improving after 2 to 3 quarters, is what you're saying.
Yeah.
Got it. And one clarification, that you have already mentioned this, but I couldn't get it earlier. You said that once we start corporate book in a few months, the difference between this new corporate book and the one we used to have is in terms of ticket size. So if you could please mention the differential ticket size that you did mention earlier as well. And the other thing that you said was, so what was the other thing? Ticket size, and the other thing was?
So one is, we will start this business in very few select cities. We will focus on good quality developers, category and category B. Third, we would do largely, construction finance business. We'll keep the ticket size lower. So basically, we would focus on very good quality of developers and good projects. There the yields could be lower compared to what normally, this business would fetch. We are looking at a yield of about around 12.25%. So yields would be lower, much safer business. So these are the changes.
Okay, yield would be 12 to 12.25%.
Yeah.
And ticket size would be?
About 200 crores.
200 crores. And ticket size in the corporate book that we used to have earlier, that was?
That was about 350, 400 crores.
Okay, perfect. Thank you so much. Best of luck for the upcoming quarters, and congratulations on a good quarter.
Thank you.
Thank you. The next follow-up question is from Harshit Toshniwal from Premji. Please go ahead.
Yeah. Hi, sir. Sorry, just one thing which is left. Sir, I'm just trying to do a calculation that we have 630 crore of quarterly disbursement in affordable, roughly 200 crore per month, and you said 70% is in-house. So that converts to 150 crore of disbursal per month in the affordable. Am I right till here?
Yes.
Sir, just one question is that if you say that 400 employees is what we have this segment sales team, then that converts to something like a 3.7 million per employee per month dispersal, which is say 2x, 3x of the other year. So if you can help me, that is our direct sourcing or basically non-in-house sourcing much higher than 30%, or where am I going wrong? Because 3 to 4 million disbursement per employee per month would mean sourcing of at least 7-8 million.
Harshit, I'll just clarify that. So 400 employees that we talked about, these are like all the full-time employees in Roshni business. They are spread across sales, credit, operations, legal, technical, all the various functions, right? Plus, on the top of that, we see when it comes to our DSP team, the feet on street that we have, the sales staff, the frontline sales staff, that is managed through our subsidiary, which is PHFL, and that number for sales right now is around 900. So, just to clarify it further, if I take a monthly volume of about, so September we did 275 crores. Out of that, about 69%, close to 70% of business was sold in-house through these 900 people. My average productivity per sales staff, per sales employee, typically is around 20 to 25 lakhs per month.
Understood.
I hope that clarifies.
Yes, that helps, sir. Because this 900 is basically so it's a 100% subsidiary which does the sourcing for us.
That's correct.
Okay, and okay, the cost of this will be more I just wanted to understand more about the subsidiary. Does this source purely for PNB Housing Finance in affordable, or do they others?
Yes. No, not specifically for affordable. They support all the three businesses. Prime, emerging markets, as well as affordable.
Okay.
But these 900 people are dedicated affordable business sales staff.
And they do business only for PNB Housing.
Yeah.
Got it. Okay. Okay.
Thank you. Ladies and gentlemen, we'll take that as our last question. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining us on the call. If you have any questions unanswered, please feel free to get in touch with Investor Relations. The transcript and the audio of this call will be uploaded on our website, that is www.pnbhousing.com. Thank you.
Thank you very much. On behalf of PNB Housing Finance Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.